Isn't venture capital feels like gambling at
It's
some
totally
point?
gambling. That's what it is. It's intellectualized gambling.
Where do you stand on this entire Web3 crypto?
Crypto is theft.
Today, I am beyond thrilled to be joined by Dan Bowyer of Superseed VC. Dan runs a very successful $50 million fund for B2B SaaS and AI founders out of the UK.
So go and work in a youngish startup and work in sales. Sell the product or service that doesn't work. That's the best, I think, baptism of fire you can have in startup land if you're thinking about becoming a founder. The instinct for humans is to stop, deer in headlights, sit on their hands, panic. And that's all that happens. It's very short-lived in venture capital. So nothing much has changed at pre-seed and seed. What has changed is the style of companies that are being invested in. They have to be fundamentals. As I call them, fundamentals. They can't be nonsense.
What's the difference between going to a Shark Tank or Dragon's Den or pitching to a VC?
Shark Tank is TV. Dragon's Den is just TV. There is nothing. There are no takeaways. In fact, founders shouldn't watch that shit. This will sound awful and ridiculous, but we have an opportunity and I think a responsibility to use money to change the world for the better. So there are lots of people that are using money just to be.
If anybody wants to start a VC from today,
Don't do it.
like, don't do it. Okay, how can they do it? Okay.
Don't do it. Just say no. Just don't do it.
Hey Dan, welcome to the show. How are you doing today?
I am amazing. How are you?
Awesome. Having a lovely time of the day. Usually when I start, when we invite anybody, I talk to them about who they are, what's their story, where they come from. And one of the biggest thing that I have learned from a person from UK, actually, I'm a big fan of his work, so Steve Bartlett. And I learned this thing from him, whoever we are, there's a context of our lives. So I want to understand, what's the earliest context you have of your life? Who is Dan behind all the successes? Who are you?
How big a question. That's a mega question. I think let's we break it down to the things that I think are influential in your life. I come from a very poor, not very pleasant part of South London called Croydon, which is the equivalent of, I can't think of a Dubai equivalent. There's only nice things in Dubai. So just imagine like a really scratty part of a town, like the very working class, low rent, low family income part of London, to a single parent, broken home, difficult, interesting childhood. While I was at school, started doing kind of teen modeling and young modeling for kids magazines and tween and teen magazines. Then got into a band, then did kids TV presenting. So I had this kind of after school, or while I was still at school, this kind of media entry into the world of stage and being on radio and being on TV, which is all super fascinating and interesting, especially if you're a young man meeting girls and drinking beer and being naughty and doing all those things that's through your formative years. And then I just didn't like much of it. So I got to about 22, 23 and left all of that world behind. And then what the hell do you do once you've gone to school and then gone into this crazy kind of entertainment world? But I've always been good at fixing computers, fixing radios, fixing my mum's friends would always bring around their appliances for me to fix Hoovers and stereos and TVs. And I was always good at fixing and making and electronics and doing things. Never trained in it, but I was always, I always had a fascination with how things worked. So then ended up, a friend of mine asked me to build a learning center, build a network of computers for Virgin Atlantic. And I was building kind of networks and tech and computers and installing software. And this was mid-90s. So kind of early days of the internet, but super early days. And people were just thinking about emailing and just thinking about the commercial application of tech. And I loved it. And I just fell in love. And then ended up doing my engineer certification. So became a Windows engineer, an Apple engineer. I didn't really care about the platforms. I just liked learning about tech. Set up a business that did it. I had an MBO with my business partner. Set up another kind of more software, social media focused business. When social media started to become a thing in the mid-2000s, sold that. And then did other weird and wonderful things. Moved to Cape Town, ran an incubator, invested in a number of startups, started angel investing, interim CEOing. And just basically messing around in startup and tech and meeting smart founders and doing a little bit of support, a little bit of consulting, a little bit of investing, just very free form, however it fitted together. Never had a plan. Lived in Miami for a bit, lived in LA for a bit. And then in 2014, my mum fell ill in the UK. So I came back to the UK, looked after her, nursed her back to health. She's now fine. Well, she's still mental, but she's fine. And then I met my now business partner in 2016, 17, when we set up the VC. So then we set up Superseed. So I was still interim CEOing and angel investing and supporting startups and founders. But I met him, and he's everything that I'm not. So I'm very flighty and very feelings based and very emotional, and just want to set my pants on fire and run around and break things and try things and build things and mostly fail. And he is very structured, financial, legally minded, strategic thinking. And we are a really good union. And we were working together, helping a mutual friend with a portfolio of companies, doing various things for these startups. And we started just to realize that we should work together, and we should, invest together, and we should build something together. And that was the root of Superseed, which is a B2B, £50 million B2B business software fund that invests in technical founders that transform business, that help big business do smart things with tech and software. And we're about to launch we're about to raise for our third fund. Between us, we've invested in maybe 50 companies. I don't really care about being a venture capitalist. It's not something that I wake up and think, my goodness, VC is so cool. It's mainly full of a-holes and difficult, and it's not a particularly nice vehicle for startups to raise through. There's either angel, friends, family, or other kind of debt and other bits. And then there's venture capital, which is this kind of very power law, rules driven thing that lives over here. But anyway, so I met this incredible guy. We set up the fund about 6 years ago. We've invested in multiple businesses, deployed about 16 million quid now. And, love meeting founders, helping them build startups, helping them sell. It's quite magical.
Amazing. Well, we were like doing some research, and we were like, oh, okay. So you went from a small town in UK all the way to Cape Town and back in the UK. So like, what the heck happened there? But now you explain that, it makes sense.
Yeah, I just like trying new things. Just get out there. I think the best thing you can do, and I'm not young anymore, but the best thing any young person can do is travel. And then the other thing they should do, if they're thinking about working in startup, is go and get a job in sales in startup. So go and work in a youngish startup.
Yeah.
And work in sales. Sell the product or service that doesn't work. That's the best I think baptism of fire you can have in startup land if you're thinking about becoming a founder.
Yeah. Why do you think so? Like why exactly?
Because when you're selling, you're at the sharp end of the business. You're dealing with clients, and I think sales unlocks everything. Sales is existential. Sales is the answer to everything. You either get feedback or you get cash or both. Right? So you either learn about, so if somebody gives you money for a thing, okay, there's something in this, then you can work out what it is and how, and find out where more of them are and then replicate that. And when they say, no, I don't want to buy your product or service because there's something better in the market, or you haven't hit the target, or there's something else going on, you get this incredible feedback loop. So either way, sales is the answer. And also when you are selling, you are doing the one job that any founder in the world needs to learn. It's the first thing you need to learn. How do you sell? Which is not just, putting on a shiny suit and being a grease monkey. It's about, hiring. You're still selling. It's like dealing with investors. You're still selling. It's dealing with clients. You're still selling. So sales is the answer to pretty much every question in startup land. So if you're thinking about becoming a founder, that's what I would say is, go and sell somebody else's stuff, because you'll learn all of the core toolkit to become a great founder.
Yeah. Why you become an investor? Why not become a founder again?
I shouldn't have done it. Given my time again, I wouldn't have done it. I like new experiences. I don't care what they are. I don't care if they're good or bad. I just think life is about experiences. The main reason that I became a VC is because I didn't have enough money to invest my own cash. So the only way to invest more cash and have more meaningful stakes in fascinating businesses is to set up a fund. There's no other way to do it. You either have your own money and you set up a family office, or you invest other people's money as a fund. I think most people don't know. I mean, obviously there's a lot of my money in the fund because you have to when you start out, and there's always the GP commit. The other thing that I think that people don't know is that all investors in funds insist that there is at least a percentage of the manager's cash in the pot, because that's how you get skin in the game and you're more aligned. But I didn't have the quantum, so I didn't have that kind of money. So I needed to invest other people's money. That was it.
Okay. I was fortunate enough to host a lot of VCs actually on this podcast. And one of the questions that, one person asked is not asked, like he was sharing something, and he's a very well-known, early stage VC in New York. And he mentioned like there's a lack of resources available out there for anybody who wants to start a VC firm. Like there's like, you can find like tons and tons of information, like how you can start a startup, like, all kind of support systems, but there's like not that much information available in terms of how to start a venture capital firm.
Yep, that's absolutely right. I mean, there's not that many people that do. I mean, there are a lot more firms than there were 10 years ago, I think.
Yeah, now it's blown up, yeah.
It's pretty 10x. I mean, that will die. I mean, a lot will pass by the wayside because of the current macroeconomic disruption, dislocation, whatever you want to call it. And also LPs, our investors, LPs, don't have the appetite to VC. They've been stung a little bit. They've been sucked into the crypto nonsense or the metaverse nonsense or the Web3 nonsense or the 5-minute grocery delivery nonsense, whatever the crap that was being sold. So there's a lot to wash through.
Yeah.
But he's right. But it's a very niche thing. I mean, even though we've probably 10x the number of VCs over the last 10 years, as a proportion of jobs or roles in the world, it's tiny, tiny, tiny. There are hardly any. I mean, in the UK, I think there are 200 VC firms in the UK, roughly. And but there's VC and there's VC. There are VCs that aren't actually VCs. There are a lot of VC firms that are actually incubators, accelerators, private equity, CVC, other things. They're not venture capital in the classic sense.
Yeah. So if anybody wants to start a VC firm today,
don't do it.
Don't do it. Okay. How can they do it? Okay.
Just say no. Just don't do it. No, I'm being a tool. If you want to start a fund, be very clear as to why, and be very clear as to why you're different. Now, we're not. We're a couple of middle-aged white men doing business software. We're about as common as they come. So we struggle with differentiation. And I think the firms of the future will be niche firms building out and layering their onion over time, but they'll start in a very specific theme, territory, customer profile. They'll start. I think that's the way to do it if you want to start a venture capital firm.
Yeah, that's a great answer. I think in my relatively smaller career compared to yours, one thing that I've seen is like there's a term called product market fit, right? So like everybody knows about that. And then we heard a term called co-founder fit or something like that. Like, you actually need to figure it out. Quite recently, probably like 6 months ago or 8 months ago, I heard the term like first time, which is called an investor fit. I think you were talking about that a few times ago, on LinkedIn as well. So in my opinion, or like the perception that I used to have from the other founders, they see an investor as checks. Okay, $500,000. So Dan is going to write me a check. So, access to cash a pile or something, a pile of cash or something like that. What exactly is an investor fit?
There is language market fit, founder market fit, co-founder, founder fit. And there are lots of, depending on how you want to view the world. Now, on investor founder fit, which is why I think you probably need to frame it. There are lots of ways to answer the question. The way that I perceive the investor founder piece is that it's a marriage, it's a partnership, it's a union. So I always look at when I first meet founders, are we going to have a fruitful relationship? Now, I don't expect us to be friends. It'd be nice, but I don't expect us to be friends. Most smart founders are what I call charmingly disagreeable and determined. So there's an opportunity for them to go off and build their business, which means they're probably not going to be that pleasant a character to be around. They're going to be working 20-hour days. They're going to be stressed, miserable, up against it. And that's not really conducive to, there's 3 to 4 years of your life when you first start out as a founder, which are abject misery. And that's not a time for having a family or maintaining friendships. So you need to, because otherwise you lose your mental health and your mental strength and your mental ability. But it's going to be a hard time. So what I look for in founders is this kind of this disagreeableness, this kind of determination, this brutality. And are we going to have a fruitful union? Do we have enough of a relationship to make a difference together, to be greater than the sum of the parts, to create something special. And it's my job to not only invest capital, but to open networks, to create access, to help them solve problems. So it's all about either me or the team or connecting in the right people who can help. And am I able to do that? Is this a business that I am able to create or support with some version of value, whatever that might be? And is there a coaching, union, relationship available between us as individuals and as teams to be able to be greater than the sum of the parts? So I need to be able to understand what that is and have a candid conversation about whether we're a good fit or not. And it's perfectly fine if you're not a good fit. That's okay. Then maybe if, I've met plenty of founders where it's not right, but I know people that it might be right for. So it's very much a two-way street. It's a relationship. It is a marriage of sorts.
Yeah. Is there like any other popular notion in venture capital that you fundamentally disagree with?
The main challenge I have with venture capital is power law, is what venture capital is based on, which is that we are going to, I read the other day, I can't remember who coined the phrase, but foie gras capital. Where did I read it? But anyway, the notion that to when founders become venture attractive, VCs like me will stuff money down their throats because we need to deploy and you need to go and crush it and kill it. So ram. And the whole power law is an ugly and brutal reality of venture capital, which is that I expect of the 30 companies that I'm going to invest in this fund, only one or two will survive. Only one or two will return the funds 2, 3, 4, 5x. It's the rest will fall by the wayside. And that means that you have this kind of disparity between success and failure. And it is the nature of the beast, but there's a brutality that I often find very uncomfortable. I would much rather invest in the 30 companies and for them all to do 2, 3, 4x and for them all to do reasonably well, but not shoot for the moon. But that's not how VC works. So the VC is the outliers. It's the fund returners. And I've always found that uncomfortable.
One personal thing I want to ask you, because I think we're going to get like very candid response to that. And that is, isn't venture capital feels like gambling?
It's totally gambling. That's right? What it is. It's intellectualized gambling.
Exactly.
We spend days, weeks, months cogitating over documents. It's all bullshit.
Yeah.
It's not. It's not. It's a necessary part of the process, but it's just like,
yeah, exactly.
It's gambling. It's gambling. Yeah. Do I believe you? I do. Do I think there are enough of them that will believe you? Yes, there are. Here's $1 million. Off you go. Go and kill it.
Exactly.
It could be, and there are plenty of VC firms that do this, that there is a low level of, the DD is, are you a criminal? Are you full of rubbish? Is there deceit baked in it? But anything above that is like fair game. And, we're just going to write checks. We're going to spray and pray. And there are models that do that. There is a VC model of just like very quick 100K checks, very quick 300K checks, just throwing them in. And then, one in 50, 1 in 100 might take. I'm not convinced. I think there are other models, but there is very little between friends, family, angel, and VC. There's nothing smarter in the middle. And there probably should be. Okay.
Taking the other side of the same equation, which is the founder side. So I was like reading the other day, 1 out of every 6, startup were able to raise money in 2020 and 2021, because that was a time like everybody was deploying cash. 1 out of 6. If VCs are looking to invest that much amount of cash, like you guys need to deploy cash, right?
Yes.
Why not so many deals are happening?
Because when you have market shock, whatever is dictating that market shock doesn't matter. When you have that, whether it's Russia, Ukraine, or COVID, or financial crisis, or whatever it is, the instinct for humans is to stop, deer in headlights, sit on their hands, panic. And that's all that happens. It's very short-lived in venture capital. And there is a lot of cash baked into VC. There was a lot of money raised in 2019, 20, 21 that still needs to be deployed. So it's only a period of inertia. There's this shock, inertia, and then it's back to business. If you look at all of the numbers, Q4 looks like it's going to go back to pretty much 2020 deal deployments. But obviously we're averaging out there. I mean, if you look at pre-seed and seed, the actual number of deals done hasn't really changed. You could draw a line through the crazy 21, 22 times, and all we've done is draw the same trajectory. So nothing much has changed at pre-seed and seed. What has changed is the style of companies that are being invested in. They have to be fundamentals. As I call them, fundamentals. They can't be nonsense, crypto, metaverse, 5-minute grocery deliveries, faster e-scooters. It can't be that. It has to be fundamentals, and it has to be kind of business fundamentals layered in behind. And growth is still taking a hit. So there will be a period of time where growth is going to continue to be difficult. So once you get beyond Series A, that whole risk profile has shifted. I think it will come back relatively quickly, but we've lost IPOs. Obviously, SPACs have died. So we're going to lose some of that recycling. Not that we have much of that in Europe, because all of the European teams go to the States to list. It will balance out, there will be more trade sales. There are lots of corporates and mid caps who will want to acquire and grow through growth. So they'll go off and buy. So we're seeing a lot more kind of micro M&A, bit of M&A, bit of PE going on in certain layers where startups are struggling and they've raised too much capital. So there are deals to be had. And I think we'll see more secondaries. So there'll be more VC firms selling off at a discount. So they'll lose and some of their assets will be spread. So that's fine. That's fine. So I guess what I'm saying is wherever there is disruption and dislocation, there is opportunity. And all that's happening is that the deck chairs are being reshuffled a bit. The 21-22 pimple has been shaved off the graphs. We're back to business as usual, and the chairs are being shuffled around a bit, and that's okay. That's okay. That's healthy. We needed to stop. The nonsense and the bubble needed to stop, and it had a very short, sharp punch in the face, and it absolutely had to happen.
Where do you stand on this entire Web3 crypto?
It's nonsense. It's theft. Crypto is theft.
Did you guys invest in any of the crypto-backed startups? No?
Crypto in 2013, 14, and got out in 18. So I realized that I got in on the ideologic kind of principle that there's a new way of distributing wealth. There's a new way of managing capital, and what I don't think people understand is that we need inflation. So one of the purported benefits of Bitcoin, just to pick one example, was this anti-inflationary, only whatever it is, 21 million coins in circulation, whatever it is. It's just nonsense. It's just not. You can intellectualize this stuff, and I don't know if you're a crypto investor, and I don't want to offend you, but it's just theft. You're taking money out of money, which never ends well. So I got to 2018 and went, oh, hang on a minute, this isn't going to work. This isn't what I thought it was. This isn't decent. This isn't, and then it just became greed, and then all the coins and the ICOs, and it will not end well. It will either be layered into financial systems and become properly regulated, whichever entity is going to do that, whether it's the SEC or whether it's other government departments, and the same across Europe. Or it'll be effectively banned and controlled and put underground. And I hope that it's layered in, because it will lose its intrinsic value. There's no greed when there is available, when it's part of the financial system. You're taxed and it's regulated. Who cares? I mean, it has no value. So I kind of hope that it's layered in rather than banned, like China. I think China and India have banned Bitcoin, or Bitcoin mining. I think so.
Yeah.
So I have a very strong position on crypto, and I'm only talking about the coins. The technology is very smart. The technology has lots of application, and I love it. So there's lots of cryptographic application, but coins is theft. I
think so. So you raised a very good point. Like, I don't know if you are a crypto investor or not. So I was I don't want to say I was a crypto investor or something like that, but I was stupid enough to do something, because I think everybody had done something. So I bought the Bitcoin, and all of that crap. But one thing that I realized, that was back in 2020, actually, but when this entire thing was like on the hype, one thing that I realized is, like, nobody's willing to learn, like, what the heck is blockchain, like what this technology can do, or like whatever they're investing in. People were like more drawn to, okay, so if I buy something today, it's going to get 1,000x, 100kx or something like that.
Fear and greed.
Exactly.
We're governed by fear and greed.
Fear and greed, yeah. Like, nobody gave a damn about, like, what the heck is this entire thing. That was like the whole concern was like, okay, if we deposit like 100K, 10 days later, we're going to be like, I don't know, 10 million worth or like whatever. So I totally agree to that. And I think, what's your opinion on this metaverse thing?
Nonsense.
So you think it's exactly the same thing?
It will have a fabulous gaming application. Some of the commercial applications around, I don't know, being able to put on a headset and operate from Cape Town on a patient in London or whatever it might be. There will be specific commercial applications. There'll be lots of gaming applications. But the thought of you and I having an interaction and living and working with a headset is never going to happen. Yeah. And I was so surprised and disappointed when Apple released the whatever it is, the big
AR thing. I
don't even know what it's called. But I was like, what are you on? You've been drinking too much of your Kool-Aid, Tim. This is just absolute bullshit nonsense. And then you read the figures, like, we only want to sell 200,000 a year or whatever, which is still going to be, a massive income. But who cares? Move the needle, improve society, create products that we want, build a car, build a TV. Why haven't Apple built a TV? It's just another big iPad, right? I mean, that's what we've got iPhone minis and we've got, iPad Pros or whatever. Just make an iPad Pro, and then we're done.
Yeah, exactly like that. Coming back to, the whole founder, like VC or like whatever, all of that is. In your opinion, because you've been on both sides of the spectrum, like you've been a founder, you've helped a lot of founders, now you're investing in founders. What are the biggest red flags when you meet founders for the very first time? And why you think those are the red flags?
There are lots of red flags. I had a call today where the founder is a solo founder, which I don't care if it's solo or duo. I mean, if you look at the numbers, the greatest rate of success is 3 founders in a team. As in those that go from nothing to IPO, it's mostly 3 founders. I don't much care. I don't care if it's a solo founder or a 2 or a 3. But this chap, I would ask him a question and he would deviate and project, and it just sounded deluded. It sounded like, if you don't have the answer to a question, you say, I don't know. This is what I think. This is my sense of it, but I don't know. And can I come back to you on that? And I would go, absolutely, yes. So that's a red flag. I mean, let me flip the question around as what do I look for that I find impressive that is this kind of this powerhouse piece? Okay. Because there are so many red flags. But the powerhouse piece, this charmingly disagreeable and determined piece, comes back to this sales piece. So if I'm on a call with a founder or a founding team and I get a sense that they've got it. This is what I say to my founders when they're going on for their subsequent raises. Now, half the people I've invested in have gone on to follow-on rounds, so that's a very high percentage. And all I say to them is, all you've got to do is make the investor feel like you've got this. That's it. It doesn't matter what you say, what you present, how you've got to effectively make the room feel confident, make the room feel like it's okay. Don't worry, I got this. We're going to make this happen. That's it. That's the essence of it. So it does come down to questioning. That some of the smartest founders I work with are always asking questions, always filling the cup, always intellectually stimulated. They never quite switch off. What is that? Who do you know? How does that work? What do I do here? And it's not that they think that I have all the answers. It's they're just constantly asking multiple people that they trust and then learning to be the best filter in the world. So I'm always looking out for, could I put you in a room with somebody from Sequoia or Accel or Benchmark, or can I put you in a room like the follow-on? Can I put you in a room with any C-suite enterprise sales team or any of the C-suite that's going to potentially buy your product, and how would you fare? Could I put you in a room with any of our partners or so investors, potential customers, potential partners? Could I put you in a room and how would you fare? Could you hold your own? Could you hold court? Could you share stories? Could you sell the vision? So they're all the things that I'm always looking for. And it's everything kind of in the later stages, it's spreadsheets, right? And I don't deal in that well, but I don't know that well. But in the early stages, it's all about this narrative and this ability to sell and be compelling and be attractive. Can you build a team? Can you sell to a client? Can you sell to an investor? That's all you need to be able to do in early stage.
And I think not many founders check in that criteria? Like there's like not many.
No, it's a very, very low percentage. But what I say to all founders is it can be learned. All of this stuff that I ask of people and I ask of myself, because I'm out raising, I'm out selling, I'm out building a team. These skills can be learned by anybody. You need a little bit of self-awareness, a little bit of ego, and a little bit of kind of effort. I'm going to go for attitude, and I don't care what anyone else says. So there are these fundamental staples that I think you kind of bring the baseline of. But then all of these behavior can be learned.
Okay, that's good to know. That's good to know. What's the best investment that you have made and the worst one? And why? What did you learn from both of them as a VC? Yeah.
Well. My funds are very young. So I started venture capital investing in 2018, like mid-18. And we started fairly slowly with relatively small checks, 200, 300, 400K checks. Our first fund was our demo fund, our learning fund. And we did 18 investments. Got it. Understand our model, understand our thesis, understand what we stand for. Okay. That took a couple of years just to hone that. So there was lots of experimentation. I wouldn't put any of them in the bucket of the worst because I don't buy into that notion of the worst. There are some, who knows which ones will succeed. We're still very young, so who knows what will happen. The key learnings are trust your gut. So when you're working with a founder who's like, there's something not quite right about this. And I've done this twice where I've not followed my gut feeling and both have borne fruit. The other side is that I should have just not done that deal. And on the other side, there's a couple of founders that I just adore. I know you're not allowed to favorite children and stuff, but they're just incredible humans who they're just going to kill it. They're going to go out and it doesn't matter whether this vehicle works for them. Obviously, I hope it does because it's the one that I invested in. But they're going to be just fine. Whether it's this vehicle or the next, they're going to be just fine.
What's the company? What was the company you're talking about?
I can't say that. I would be in trouble.
Okay.
I don't have favorite children, but they know who they are, and there's a small handful that go, you are just ridiculously impressive people doing impressive things. And I learn from all of the founders that I work with. That's part of the joys of being a VC is that I get to learn about these weird and wonderful topics like intraday bank liquidity, edge computing, supply chain demand forecasting. I get to learn all these topics that I would never be exposed to in the normal world, and meet people that are experts in those domains that are just unbelievably smart, and it's a privilege.
One thing that comes to mind is, and this is again scratching a personal itch because I started out in products like early on. My career was around products. Like that's all that I knew. How likely is a VC fund to invest in a copycat sort of a product?
Well, there are some models that are based on it. The old Rocket Internet model was based on it. I think they were the first big play to just effectively look at the States, rip it off, launch it in Germany or
in the Europe
Egypt
or something
or wherever. And I think that's just hateful. That's just hateful shit. That's the thing that inspires me about venture capital startup is the reinvention. There's no such thing necessarily as a new idea, but we are pure innovation. We are going to be the net creators of jobs and opportunities in the future. So the startups that are coming through that I value and rate, and obviously that I invest in on the B2B side, are the ones that are transforming the old. They're finding new ways to solve problems. Anything that is just replicant stuff is just go and make sandwiches and go and do something else. That's just hateful. That's just opportunistic nastiness.
Yeah.
I'm a very emotional creature. I have no time for that stuff. Some people can make lots of money on it. I don't. I just don't do it. It's just we have a. This will sound awful and ridiculous, but we have an opportunity and I think a responsibility to use money to change the world for the better. So there are lots of people that are using money just to make more money and be opportunistic. But we have an opportunity now to take the capital that we have and invest it in people and ideas that are going to absolutely transform how the world works. And that's what gets me out of bed, and that's the most important thing. It's not money for its own sake, because that's just misery. But to actually try something new and build something new and change a way that something is done. That's how we solve climate change. That's how we solve all the DEI change. It's if we're constantly looking for things that need fixing and reinventing and circulating in that way.
Yeah. One company that pops up, and quite recently, something happened. So I just want to pick your opinion on that. What do you think of WeWork? Of all the crap that's been that's happened? Yeah.
It's if you said to somebody, look, I'm going to get my investors to subsidize a really nice office for you so that you pay 20, 30, 40, 50%, you're going to say yes. So that's it. There is no, I mean, it's lovely that Ubers and WeWorks and there's a whole plethora of these kinds of businesses came through, because, well, actually Uber's a bit nastier, because they effectively crushed lots of mom and pop shops and taxi ranks, and
100%.
so there's lots of horror stories of Uber drivers committing suicide because they couldn't make the salaries that they were promised, and I know that there are edge cases in any transformation, but there's some horrific stuff going on there. So to crush a market and discount on investor capital and then start putting your prices up, I understand the strategy intellectually. I just cannot reconcile that. I think it's massively unpleasant. On the Uber side, what we're left with is the ability to walk into any city in the world and reliably find a taxi. Now, that is quite an incredible feat. So I'm not saying it's always one. It's not. These things are never purely one-sided. WeWork, there are going to be a lot of landlords in cities that are going to lose a lot of money at a time when commercial property and commercial landlords are already under it because of COVID, and people aren't, hybrid working, aren't going back to the office. So I don't massively feel sorry for most of these people, because most of them are mega wealthy and they'll be fine. They're not going to be eating ramen noodles. But at the same time, it just feels wasteful I love the innovation, and I've had 3 WeWork offices in my life so far, and I love the offices. They're beautiful and it's lovely.
Yeah.
But it goes back to my other point. It's a bit of a shame that it's just kind of, we've wasted billions of dollars on something that's not really all that meaningful.
Yeah.
Nice, loved it. Thank you, Adam. Thank you, Mayoshi. Thank you. But I don't.
Yeah. My follow-up question on that was like, why waste that much amount of money?
Well, what's a waste? I mean, if you think about the tendrils that were released into the commercial world, so there would have been people that were building these offices, there would have been landlords that were renting these offices, there would have been employment for people to come in and work these and operate these offices. There was this whole community push. I know it went a bit too far with the indoor surf school and whatever other nonsense Adam Neumann was doing, but
yeah,
that's egomaniacs for you. That's narcissistic psychopaths for you. That's part of our world. In venture capital and startup founding, that's psychopathy is a big part of it, and I think the world would be a worse place without them.
Okay.
A lot of things wouldn't happen, without some of the psychopaths that are out there. I mean, look at Donald Trump. But let's not get into that. But I forgot what you asked me now. The question's just left me. I got stuck on Donald Trump.
He's a character. The question was a lot of money that that was invested that went to waste. Yeah, so it was a waste.
It didn't get wasted. And again, those that were investing, and there were a lot of funds that will not do well, and a lot of people that probably shouldn't do well that have done extremely well. And I put Adam Neumann in that bank as well. He's how billions did he walk away with for being fired?
Yeah, 1.7.
It's just a bit of a joke that people didn't look at the fundamentals. This can never work. This business can never work. It's always kick the can. The never. It's okay. Like with Uber. Oh, when we have flying taxis, we'll make money. It's like, it ain't gonna happen. When we have self-driving cars, we're gonna make money. That's never gonna happen either. So it's that whole kick the can, never attitude. I find offensive in VC specifically.
Yeah. Okay. Okay. One last question that I personally want to ask you before we get into that audience, segment sort of a thing.
Yeah.
What's the difference between going to a Shark Tank or a Dragon's Den in the UK or pitching to a VC? Like, what's the difference between all of these things?
No, there's chalk and cheese. It's like it's cars and airplanes. They're not. Shark Tank is TV. Dragon's Den is just TV. There is nothing. There are no takeaways. In fact, founders shouldn't watch that shit. You should run for the hills. We shouldn't be investing in economies that we don't like, and that's just entertainment. That's just television. So there is no comparison.
Okay.
So there is no answer to that question. I mean, pitching to a VC is having a vision, being able to sell that vision, and having customers that care about your vision and that you can take on a journey with you, and then investors and team members and whatever. Shark Tank in Dragon's Den is just shit TV.
Okay. But a lot of people, especially from founder standpoint, they do, market that thing like, okay, we went to Shark Tank, raised that much amount of money. It becomes a part of our like marketing gimmick or whatever you want to call it. Oh, as seen on Shark Tank, as seen on Dragon's Den or something.
If that works for you, then all power to you.
Okay. That's a good one. All right. So as I mentioned, before the chat, so we have this audience and people are kind enough to submit some questions. So there's like only a hand pick of these. And again, like there's a ton of those, but I think we would consolidate all of them into these ones. So and they're like not in any particular order, just like randomly. So what are the most overlooked terms in a term sheet that our founders should pay more attention to? That's the first one.
There are a small handful of terms that you need to be mindful of, and most people will know them. I think the challenge that you have really is getting a good lawyer and understanding the terms that will affect the terms. So you will negotiate all kinds of reverse vesting, preemption. There'll be a whole bunch of stuff that is there to protect the business, stuff that is there to protect you as the founding team, stuff that is there to protect the investors. There are no hard and fast rules. There are some things that look particularly ugly, but are probably potentially quite meaningful and required for you at this stage of business. The only thing that you must do is whatever terms and whatever valuation and whatever you raise, whatever that is, remember two things. One is you only refer to these documents in times of trouble, right? So most contracts are only useful when the shit's hitting the fan. Everything else is negotiable or workoutable because you know things are going well. So of course you need them, and of course they're very important. They're a very important backstop. But all you really want to do is be using these terms to set up the next fundraise. So you must make sure, for example, use one example, a cap table. If you own less than 50% as the founding team of your own business at Series A, you have a problem. Now it's a solvable problem. You can build an options pool and you can reverse vest, and then you can give yourself some more of the options. So you can shuffle. It's problematic, but you have to constantly think, well, what do we need to do to get this term sheet, these terms right, so that we're on the right trajectory to build a venture scale business at Series A, Series B, and beyond. There tend to be ways to unmess. I was going to use a stronger word there, but you mustn't. You must always just keep in mind to set up one round ahead. But to pick up on any specific, I mean, double dipping. So you've got to watch out. You know how each investor is rewarded, and to make sure that there are no clauses. You know, you're not paying exorbitant fees, or you're not paying annual fees, and there's nothing in there that is giving anyone any kind of the double dip prefs. I think is particularly pernicious. But there's nothing in there. There are certain things that you might want because it enables other aspects of the deal to go ahead. So negotiate, understand every single line item, get the lawyer to work out the terms that are going to affect the terms. Understand that you will lose. I mean, there is an element in the earliest stages of feeling like you're losing control of your own business. That's not the reality, because everybody is aligned for success here. We are completely aligned. We're investing in you because we believe in you to succeed. I mean, that's the basis of the investment. It's not to scupper you by term. There are often protective rights in there in favor of early VCs that can be sometimes a little bit ugly. Double dip prefs is probably the most pernicious.
Okay, I appreciate it. Can you take us through your due diligence process at like Superseed? What are like some of the red flags that can immediately hold the whole investment opportunity?
The due diligence is broken down for us into two main buckets. One is what we call commercial diligence. Do customers care? So we'll do a whole bunch of due diligence almost on behalf of customers and new customers and potential customers. Do they care? The other side of due diligence is pretty much box checking. Are you a criminal? Has what you told me, is it baked in lies? Does it make sense? Do you really have these contract values? Is there really this much cash in bank? So they're just very, very, and there's maybe 20 or 30 just tick boxes, sending in, passports or proof of ID. I mean, it's properly administrative checkboxes. So for us, it's the commercial diligence, which is, do customers care? And we're speaking to existing customers, we're speaking to potential customers, and we're doing that, the customer viewpoint as part of our due diligence. And the other is just a checkboxing exercise. What you need to do is two things. One is to have a list of, get the list from any VC of all of their DD items and just put them into a data room and protect it. Okay. Don't send that to anybody and get them all in a data room. Yeah. Protect them all, have everything all very clearly labeled, have a spreadsheet noting and linking to where everything is, or it can be in a Notion database or whatever it is. And the other thing to do is to have an FAQ. So all of the stupid questions that investors ask you, collect them all and have that as part of your DD. So have that as part of your header. It's part of your pitching, but have it as part of your DD material. All of those stupid questions that people like me ask, list them all and answer them all in an FAQ format.
Okay. And then the other part was, what are some of the red flags that can immediately hold the entire investment process?
If customers don't care. For me, the only thing I care about, assuming there are no red lines in the hygiene stuff, so you aren't a criminal. The rest of it is, if we cannot get any customer pull or any form of customer draw, and we've only had this once, but in process almost at DD. So we just couldn't get anyone. We believed in it intellectually; it made sense. We just couldn't get customers to care. So that's the main thing. That's not really a red flag. I mean, that's something that's just a data point. Then you go back and okay, we need to tweak or pivot. That's okay. Invariably there's still something in that area to solve because you know it, you've lived it, so you can see the thing. You see. But then you've got to work out how you approach it. So it's either a tweak, a strategy, or it's a pivot into a whole new way of solving that problem.
Yeah. Okay. Yeah. That's helpful. So once you have invested in a company, how hands-on are you typically? Like, do you prefer founders to reach out like proactively?
As much as founders need. So it's not our business. We're not here to run the business. We're not here to get operational. Okay. But for hiring, most founders screw up hiring, senior hires. So we very much help with that. We have an internal head of talent. We very much help with the board packs or the financial structuring. So it's another thing that founders don't have the skill set for, the time for, or the inclination for. So we will help build the financial model and then effectively framework the financial model so that everything for management meetings and everything for board meetings is already templated and done. So that's something we can take off the table. So hiring, financial modeling, and also what we call like the startup OS or startup ID, which is the ability to, once you've raised it, when you've got a couple of million quid in the bank, you do a number of stupid things. You'll hire the wrong people, which we hope to solve. You'll start spending money on, you'll start deviating off, because you can experiment too much and you can try too many things. So we go back to this startup OS piece, which is why you get out of bed, where are you going, what's the next thing that you need to achieve, how do you communicate that to the market? And that's all mission, vision, position. It's all those kinds of aspects. So we workshop those things with founders. But when it's the right time and when it's required, it's our job to either put things in the way and get things done or to take things out of the way. That's our job on the value piece. But really, we're investing in people because they're amazing and they're going to go and kill the world.
Do you because you have like internal head of talent, is the idea subconsciously is to hire somebody and put it in the company so you can, keep every single thing in structure? Or is it just like, no, if you need it, we can help you. If you don't,
it tends to be the first hires that we tend to do is as startups move into kind of quite a drawn product market fit mode, is then hire in a really powerful head of sales who can then transition from founder sales to a systemized sales, so a go-to-market strategy. and they tend to then understand, work with the founding team or the founder or the CEO, bottle them, and then create a system around that, what works, because the founding team have probably done this for a couple of years and worked out what's good, bad, and ugly, and then they can turn it into a proper go-to-market playbook. So it's not about anything to do with control or us being in any way dictatorial. At the right time, we need to systemize this function, and we start with sales because that's what we're all about. And that tends to be a CRO or a head of sales or whatever you want to call them, who then or bottles founder sales or unbottles it, depending on which way you look at it, and then creates the system and the playbook. And that's, I think, is really powerful. And it's proven. I mean, it's proven to be powerful.
Had a question around control, but I think you already answered that. So why most founders have this notion that, VCs want to control the whole business? Why is that a widespread sort of a notion out there?
Conversation comes up a lot at, for example, when you reverse vest. So when you take a funding round, you'll probably have to, let's say you own 80% of the business and you've raised a pre-seed, you own 80% of the business, you've given 20% away at the previous round, you will have to probably drop whatever to 50% ownership and then revest, because if we're giving you a couple of million quid, there's almost a payment for that, which is, we need you to kind of think back a step, almost have reskinned in the game to then earn your full ownership in the business. Now that feels really kind of sucky, controlling. It's like, almost how dare you? But if you think about it from the other side of the desk, it's like, well, if I give you 2 million quid and then you decide to sell yourself the business for £1 and you've got 2 million quid in the bank and there's no way of me exercising any control over it. I mean, so yes, there's a trust piece, but there has to be some weights, measures, controls in there that will stop you from being a dick. Because you can. I've seen companies sold to their cousin for £1 and then they milk all the money out and they still own 80% of the business, right?
Yeah.
So there are mechanics in there that can sometimes feel heavy-handed, but that's the price of taking a substantial chunk of venture capital. And the other thing that I think many founders don't appreciate is that many founders, by the time they either trade, sale, or IPO, own less than 5, 10, 3% of their own business. It's a really good question. I mean, in some instances, when they've got it wrong and they've taken too long and the risk has changed and other people have picked up that risk profile. Yeah, I mean, sometimes having 1% of a $1 billion business is much more than you would ever have made had you bootstrapped. Sometimes it's too heavy-handed, and sometimes there's been too many funding rounds. Sometimes the cap table has been too screwed, and there's just no way out of it, and they almost become figureheads in their own business. Sometimes that's how it rolls. Is it pleasant? No. Venture capital is not nice.
Exactly, but it's a necessity. One thing that comes to my mind, because you mentioned the word bootstrap, and I happen to interview a lot of people who are like, they build a bootstrap business and manage to exit that and whatever. Why is there a sense of a pride in all the bootstrap founders?
Is it pride? Is it?
I don't know. But there's some sort of a cockiness out there.
I'm going to do it on my own. I think there is something mega impressive if you are going to build your business on a bit of debt, a bit of friends and family, a bit of client money, and you're going to build it and you're going to hustle and you're going to build it and you're going to sell. That, I think you absolutely have the right to feel incredibly proud of and for. I think that's just. If you do want to get on the venture capital track and you are ready to pour venture capital fuel on the fire and you want to build a global business, then you take a different track, and that's exactly. And it's just horses for courses, right? So and I think there's no better or worse. It's your personal choice. It's not there is no natural progression from friends and family, angels, venture capital. It's not a linear path. It's a choice. It's a lifestyle choice, which doesn't have to be small. You can have extremely substantial lifestyle businesses, or it's a global business and it's venture scale. There's very little in between. Either going to bootstrap or debt and small funding rounds and build, or you're going to go, screw it, I'm going to go global and we're going to take this massive and I'm going to raise and as impressive a VC as I can find, and the most amount of capital that I need to achieve my objective.
Yeah. Okay. Yeah. The next one is kind of a funny one. When you decide not to invest in a startup, do you generally tell them why? What are the most common reason of rejection anyway?
I try to always be honest. It's a very strong part of my personal value set. Sometimes I can't be honest with founders because partly I don't feel like it's my place. What the hell do I know? Partly I want to not open floodgates which are unnecessary or cause unnecessary distress or what, so what, it doesn't matter. Everyone will have a different opinion. So the next VC will think you're wonderful and I think you're an asshole. It doesn't matter. So it's kind of like partly it's not my place and partly I don't want to open that floodgate or that conversation path. But that mostly I would say 90% of the time, I'm very direct and very honest, but caveated with it's just my opinion. And I would say most of the time that I don't invest is because of the founders. So that's a really hard conversation to have. It's like sometimes when we're mid-process, this isn't right because you're the problem. That's a really hard conversation to have. I tend to change the language set around it. I don't make it so accusational. It's more a case of, I don't buy it. I don't buy this. I don't buy this. What I'm really saying is you. And if you don't know that and you can't hear that, then that's even doubly more the problem.
Yeah. How do you resolve that in case you don't like the founder? Like,
it's not a case of liking. No. It's not about liking or disliking. It's about I don't buy you. I don't buy that
as
you
a person, as a leader of the company or something.
It's all about the team. The founding team have to be able to, and it's the hardest job on the planet to create a new way of solving a problem, and not only to understand the content, but to build a business around the content. It's the hardest job on the planet. And you're starting from nothing, back of a napkin and a conversation in the pub, and then you've got to build the first thing, and then you've got to hire the first boy or girl, and then you've got to sell the first client. It's ridiculously hard, right? It's the hardest thing. But if it's not going to be a venture scale business or I don't believe that you can do it, I think there's a version of the truth that is always available.
Okay. Okay. All right. So what's an ideal pitch deck for you, and how do you evaluate pitch decks in general? Like, what's the attention span? Do you spend like 3 seconds looking at the pitch deck, or do you spend like 30 minutes? I doubt that, but yeah.
I think everyone's different personally, and there are lots of pitching tools. I hate them. I want a really simple, if it's cold, I want a really simple, no more than 10 slides, visually appealing, narrative driven pitch deck. So I want to go, and I've written a long post on this. I've deconstructed most of the successful pitch decks that I could find, and then codified what element, content, and what the context of the slide should be. And there's 10 slides. So, and it's all the stuff that it doesn't have to be called whatever, problem, solution, team, financials, track. It doesn't have to be called those stupid titles. Get creative. Don't be boring, but at the same time, a very simple, flat PDF, no more than 10 slides. I will spend about 10 seconds per slide, and I want to feel a narrative of this is interesting. These people are interesting. They're solving an interesting problem. I want to just feel there's something in it. I don't need to know all the details. You don't need to drop your underwear. I don't care about the mechanics. I care about, who are you? Why do you exist? And why are you solving this problem? It's like if I can buy into this trend that you're leaning into, this problem that you're solving, this community that you're serving, and feel like it's a venture scale opportunity and you're the team to build it, I'll pick up the phone, or we'll have another meeting, or we'll go into more materials. But it's very simple. Cover all the major food groups, break some of the rules to be interesting, make it visually appealing. It doesn't have to be that beautiful. It doesn't have to be designed by Van Gogh, but it needs to be something that I'm not kind of squinting and trying to decipher. Don't cognitively overload me. And it's a flat PDF, no more than 10 slides if it's cold. If it's warm, you might entertain a few more, but generally, fewer than 10 slides, flat PDF, attached to an email, a couple of teaser bullets. Looks like we're a fit for your portfolio. Looks like we really fit your thesis. Here's why I want you to invest in us. 5 key bullets of your key metrics and a teaser pitch deck.
Okay. A follow-up on that is, how much of a personal relationships / warm intros really influence your investment decisions?
They don't. What they tend to do is open the door, but the thing still needs to be on thesis, impressive. Same. You might give it a bit more time because you feel a respect for the person that referred you, but you're not going to. If it's not right, it's not right. And there are stories of, if you invest in my team, I'll invest in your team across VC, and there is a little bit of that. I've never experienced that, but I've been told that goes on. I don't buy it, and I especially don't buy it when the chips are down. Right now, the venture capital market is not that buoyant, and I don't think anyone's going to play those stupid games right now.
Yeah. Okay. One thing, just personally want to ask is, how common is it for VC to kick out the founder when the growth actually stalls?
It's not. I mean, these are the serious minorities. Founders typically make shitty CEOs. Typically, if you're a great founder, you're not going to be a great CEO. It's a different skill set. One is spinning plates, magic, sales, pants on fire, and the other is systems, processes, spreadsheets. They're very different skill sets. I mean, if you look at, Google, you look at Larry Page, Sergey Brin, they brought in Eric Schmidt super early to run the business. I mean, there are lots of stories. I mean, Zuckerberg doesn't run his own business. There are lots of stories of very impressive founders, the creative minds, bringing in really powerful operators to actually run the business. I don't know if that answers your question, but it's as long as you have the awareness, it doesn't happen often. As long as you have the self-awareness, you need to have the ego to go for it, but you have the self-awareness to go, this isn't my skill set. I need to functionally bring in somebody to replace this thing that I'm not very good at, or to bolster this thing that I think the business needs. I think the only time that founders get replaced is when they're dickheads. They're genuinely, because the board don't want to get involved. The board don't want to replace you. There is no incentive ever for anybody at board or as an investor to replace you. It's the worst thing. That's the worst thing. It's so disruptive. It's such a time sucker. You will invariably get it wrong. It invariably doesn't work. So it's the path of last resort.
Mm-hmm. Got it. Okay. So another thing is, does a startup that's failing reflect poorly on a VC that's invested in them? So you invest in like 30 of the companies, and God forbid, and like 3 of them are like horribly wrong.
I expect of the 30 companies that I invest in, I expect 15 to flat fail.
Okay. Like just go like 0.
15 will flat fail. I would expect 10 to return some version of capital. A 1x, a 1.2x, a 2x, a 3x, a something x, a sub 3x something. And I would expect 2, 3, 4, 5 to be significant operators, and 1 or 2 hopefully to be fund returners.
Suppose, of those 15 companies, companies in the founding team, they come up with another idea, they have another breakthrough or something like that. Will you invest in them again?
Yeah, absolutely. If I invest in people. So sometimes the vehicle isn't right. Sometimes the vehicle needs to be thrown away, we just invested in a founder who's found another co-founder who was one of the earliest founding teams of another startup that we invested in. I absolutely, every day of the week. I mean, there are lots of stats around second-time founders outperforming. And there are firms that will only invest in second-time founders with a minimum of a $10 exit, a $10 million exit. So that's their strategy. They'll do this thesis, but only second-time founders that have had a semi-decent, not too decent because you become lazy, but a semi-decent outcome.
If the startup pivots, how often do you guys support it?
I will support the founding team ad infinitum. There's no rule.
So if they pivot, like whatever.
Listen, if they're pivoting every week because they're being unfocused and lazy and stupid, I'll have serious words. But I mean, that never happens. That's never happened to me. That's not common. What tends to happen is that after a major funding round, everything gets a bit loosey-goosey.
Yep.
And then you need to have some pretty serious words to get back on track, because egos are strong, and they've got 10 million quid in the bank or whatever it might be, and they think they've got it. They think they've worked it. It's like, nah, sunshine. I mean, even post Series C, 50% of startups fail to return capital. And post Series C, you look like a substantial business. You will have hundreds of employees. You'll have raised hundreds of millions of dollars. So you will look like you've got it. You'll look like you know what you're doing. Even those guys and girls half the time fail to return capital.
Do you think there's a sense of ego / pride, cockiness or something like that in founders who raise a lot of big rounds? Like, oh, I just raised $50 million or something like that, right?
Of course. I mean, but the irony here is you've got a bucket load of debt.
Oh, that's the other side.
It's not debt. It's not.
Yeah.
But you basically you've managed to get a bad credit card. Who gives a toss? You've done nothing.
I mean, it's more responsibility than ever before.
Yeah,
right?
It's awful. It's awful weight. It's a horrible weight. But you need to have an ego the size of a planet to handle that. It's like, I've got this. I can do this. I've got 100 million quid in the bank. I'm going to go and kill the world. That's the
mentality.
That's the attitude.
Yeah. So one of the things that I do on the podcast is started recently. I consider myself as a lifelong learner. So I ask everybody one question that I personally want to learn from them. So the one thing that I want to learn from you is, and this is, the context of this question is, so I see you building this sort of a community brand sort of a stuff on LinkedIn, like you talk about things that most people don't want to talk about, right? Or like, bringing that reality check behind those things. So I want to ask you, how important is it for a founder to build his personal brand? And does that actually help in fundraising or not?
I can answer this both ways. One way is focus, get off all social media, delete social media, and focus on building a business. And the other way, and I could go into more of that side of that hand, if you like, that side of the fence. The other side of the fence is, if you have a credible digital profile, you will be able to hire more easily, fundraise more easily, sell clients more easily. But it's a double-edged sword, and it takes a lot of time. And when I started writing, it's because my partner said, look, we need to build a personal brand, and I was like, oh God, another middle-aged white man VC talking about stuff. So nothing will fill me more with dread than putting myself out there under that guise. But actually what I realized is that I love it, and I love learning and sharing. And I'm not learning and sharing to teach, I'm learning and sharing to learn more, because the very process of writing, and I don't know if you find this with building your podcast audience, the very process of thinking about the topic and articulating it in different ways embeds it in your brain in a whole new way. And sometimes I can be writing things and I didn't know I thought that. I didn't know that was the depth of that topic or whatever it might be. So it took me about a year, and I'm writing to learn, not to teach. But to me, it was about building a brand and having an opinion and being out there. It make me feel a bit sick. But it's so should founders be doing that? I think on balance, no, they should be focusing on business, and they should probably delete all social media and focus on the weighty task of building a business. But there are caveats in there.
Okay. So Dan, I appreciate it. We do have this small ritual on the podcast. And what we do is we ask all our guests a question for our next guest without telling or knowing who the next guest is going to be. So we have a question for you. And obviously I'm going to take a question for our next guest. The question that we have for you is, if you were to go back in time and invest in a business that you think now have done they've managed to get to a great success heights, like whatever, if you can go back and invest in one business, what would that be? That you think you've missed the opportunity?
Any business in the world?
No, the one that comes to you and you kind of missed that opportunity to invest in them.
Oh, passing on the Beatles. I've not had one. I've been asked this before. I've not had a Beatles moment yet. Maybe it's because I haven't been investing for long enough, but I've not had a Beatles moment. Or maybe I don't see the world that way. But there is one startup where the founding team, or the founder really, didn't take our money because they got a ridiculously overvalued offer from an incredibly impressive VC. So of course, I was like, I can't even compete with that. The brand, you need to get that on the cap table. I totally understand that. And the valuation they've given you at the stage of that is just nuts. So I can't compete. And regardless of not being able to compete financially, you should absolutely get that brand on your cap table. And then they wanted us to come in but not lead. I was like, I can't not lead. I can co-lead or lead, but I can't not lead the rounds because we've tried that before and it just doesn't work. For our model, it just doesn't work. And that's a bigger topic. But we still stay in touch. He's asked me to be his coach. He's asked me to be an angel. We stay in touch. We speak often. And that's all I care about. Of course, I would have liked to have been the investor, but I never put that in the Beatles that got away. You didn't sign Elvis Presley or whatever that phrase is. So I don't have one yet.
Okay.
Ask me next year.
Absolutely. One follow that comes to mind is if an investor or a VC, another VC is just like giving you a lot of money on an absurd valuation, as a founder, should you take that much or not?
I always raise around request. So to me, I will only ever raise what I need to achieve the next milestone. So what I'm like, so raises in the early stage, the pre-seed, seed, or whatever you want to call them, tend to be, for me, milestone driven or mission driven. My definition of mission is an achievable thing. So a milestone, a big milestone, and they tend to be wrapped around, the next raise. So I want to, if I'm a seed, I want to achieve series. I want to achieve a really substantial Series A, which in my world is about £200,000 a month in SaaS revenue and a really healthy pipeline, a fat pipeline of SQLs, MQLs, all the way down to, almost chomping at the bit, waiting to become a client. I've lost my train of thought. Blimey, it's been a long day. So that, I think the
question was, should as a founder, should you take higher valuation rounds or not?
Yeah. If you want to achieve a thing to get to the next stage, you shouldn't be doing that by having money shoved down your throat by a VC or any investor. You should always raise what you need, which is that piece that I just mentioned. And what I tend to do is, if you think you need, I don't know, whatever, 18 months and £1 million, then just add 50%. It's, whatever, 24 and £1.5 million. Give yourself a bit of breathing space, but not much. So don't raise it crazy because that would just bite you in the ass at the next round. You want to do a flat or a down round, and that's miserable. So just raise what you need. Don't give too much away. Raise what you need to achieve the thing, but give yourself a little bit of wiggle room because you will mess it up. And that's okay. That's normal. That's learning. They're valuable lessons, but you haven't hit the metrics. So no, I wouldn't take crazy money, crazy valuation, crazy quantum. Don't take too much cash. And don't take too much cash at crazy valuations. It will kill you. Too much money will kill you just as easy as too little.
Okay. Thanks, Dan. Appreciate the time. Loved it. And thank you so much for the candor. Thank you so much for opening up and sharing all these things with us.
All of the goodness, all a pleasure.